So what is a HELOC and how does it work? So in this video, I'm going to give you a very simple, easy to understand explanation of how do HELOCs work and what even is a HELOC. So my name is Sam Kwok, one half the Kwok brothers. I'm a certified credit counselor and I've been helping homeowners pay off their mortgage for almost 7 to 8 years now. And I get this question quite a bit for those that maybe not so familiar with a HELOC. So a HELOC is actually an acronym for home equity line of credit. So a HELOC is a type of a line of credit that uses the equity of your home as a collateral to obtain access to credit. In other words, your credit card is actually a form of a line of credit. And with the line of credit, the banks will establish a maximum limit in terms of how much you're allowed to borrow at any given point. And of course, you do need to pay back, and there's typically a minimum monthly payment each month. And line of credit, of course, like any other loan or debt, has interest rates. But the only thing that the line of credit does not have compared to, say, a mortgage or an auto loan is a set term or an amortization period to which you're required to pay it back on a specific date. So a line of credit doesn't have a specific due date. It does have a minimum payment every month. You do have to pay interest on the balance that you owe on a average daily balance. And we'll talk a little bit about that in just one sec. But let's go specifically into a home equity line of credit. So number one, the way that the line of credit and the limit itself is established is based on what's called an LTV of your home. Now for this, I'll demonstrate this on a whiteboard for our visual learners out there. So let me go and share my screen and share a whiteboard, and there we go. So there are actually two different types of a line of credit. There's a first lien HELOC, and there's also a second lien position HELOC. Now let's go to the second lien because it's probably the most common form of HELOC, and a lot of times when you go ask for a HELOC at a bank, this is the type of HELOC they'll most likely give you. So an LTV stands for loan to value, and what this simply means is that this is the maximum percentage, and this is typically expressed in a percentage, and this is the maximum percentage of debt you're allowed to have against the value of your home. So if the value of your home, your market value, $100,000, and of course, this number can change depending on the market forces and what's happening, and obviously the most accurate way of determining the value of your home is through an appraisal. But let's just say that we know for a fact your home value is $100,000. If the bank is willing to give you what's called an 80% loan to value loan, the maximum amount of loan that they're willing to give you on this house is $80,000. Okay, so when you got a mortgage, and let's say the bank says, hey, we're going to give you a 90% loan to value mortgage, that means they're willing to lend you $90,000 against this $100,000 home. And obviously the difference of 10 grand will be something that you would have to be responsible for. That would be considered the down payment. So in this case, with HELOCs, they could be anywhere between 80 to even 100%, what's also known as CLTV, which stands for combined loan to value. That means the bank is willing to give you a home equity line of credit of maximum of 80 to 100%, when also combining the mortgage balance as well. So let me illustrate that for you one sec. So let's say you owe $70,000 on the same $100,000 home value, and this is a mortgage that you currently owe against the house. Now, if the bank is willing to give you, let's say, a 90% combined loan to value HELOC, what that means is that with your mortgage balance plus the HELOC balance, the maximum loan you're allowed to have against that $100,000 home is $90,000. So in this case, the maximum line of credit limit that the bank will give you is $20,000 in a HELOC, which ultimately, if you total this up, that will be a $90,000 debt against the home. So when you walk into a bank and they'd say, hey, we'll give you a 90% combined loan to value, CLTV. What they're going to do is they're going to first figure out how much do you already owe on this house, determine that percentage first, and then give you whatever difference is. So again, 70% LTV. If they're willing to give you a 90% LTV or combined loan to value, then $20,000 is the maximum they'll they're going to be willing to give you in terms of line of credit limit. Now, this is a little bit different when it comes to, let's talk about a first lien position HELOC. So let me clear this out. With the first lien position HELOC, it's a little bit different. Now, with the first lien, what it means is that instead of getting an additional HELOC on top of your existing mortgage, what happens is that the HELOC would actually replace the entire balance of your mortgage. So what it would actually be is, technically, it's a refinance. So what you have, let's say here is your mortgage, and let's say you owe, again, $70,000 on a $100,000 value, $100,000 property. And what's going to happen is, let's say the bank is willing to give you an 80% loan to value HELOC. What that means is, instead of giving you just a $10,000 HELOC, right, to meet that 80% combined loan to value, they will completely transfer this over to an $80,000 limit HELOC, right? So this has an $80,000 limit because this is, again, 80% loan to value. But out from the get-go, you would still owe $70,000. But instead of being a mortgage balance, it is actually now a HELOC balance. So what you have available to be able to use is actually still $10,000. But the benefit of a first lien HELOC is that as you pay this down, right, you pay that $70,000, $60,000, now you actually have automatically $20,000 of a line that you can use that's ready for withdrawal, or the technical term is draw, for you to use for whatever you like. So the difference between a second lien versus a first lien is that with the second lien, you have your existing mortgage, which is actually the first lien mortgage. Then you'll get another loan, which will be a second lien, and it just happens to be a HELOC. Whereas a first lien HELOC would be a technical refinance from a mortgage and replacing it with a HELOC, where now you have a $70,000 HELOC balance in this example, and what you owe, the only thing you owe in your house is just the HELOC. That's it. So that's how HELOCs work. In fact, loans, home equity loans, work pretty much a similar fashion. The only difference is that with the HE loan, you do have a set term or a set amount of time that you do need to pay it off by, just like a regular mortgage. So that's the main difference there. So that's how a HELOC is often offered and how it works. It works just like a credit card. Again, the only difference is that it uses your home equity as a collateral, as a security, which all that means is that if you fail to pay your HELOC back, the bank could pursue a foreclosure and take your home. Obviously, we don't want that. So that's how the HELOC works. Hopefully, this explanation was very simple for you to understand. And if you have any questions, leave your comments down below. We'll love to answer them. Check out some of the other videos we have about financing and how to pay off your mortgage faster, and other helpful tips when it comes to home ownership. So definitely check it out, subscribe, and we'll see you in the next video.